Hi everyone, good evening. I hope everyone is doing fine. So we are back again with another interesting session, and today we have with us Vihang Naik. So he's a co-founder at Bristlecon Equity Fund. Vihang has got 18 plus years of experience in capital markets, of which 12 years are focused on investment management. He's a CFA and he also holds a degree in management. And in his previous stint, he had held many senior positions. To name a few, he had worked with HSBC Asset Management, L&T Asset Management, and he has also worked with Motilal Oswal. And in his recent role, he managed over 1.5 billion US dollar in equity assets for mid cap and large cap funds, which we would be knowing more during the course of this section. And the L&T Midcap Fund was also awarded the title of Best Midcap Fund by CNBC in 2018, handled by Vihang, and he has also successfully led three new fund offerings during his tenure. And apart from the equity markets, he also enjoys reading non-fiction. He loves to travel and playing golf. So, anything which I missed on your introduction, Vyang, I would appreciate if you suffice that. But again, I would appreciate if you start from like how it all started for you, like the capital markets journey.
Right, right. Thank you to all my listeners here. I'm a first generation investor. I don't belong to an investing family. I was also always intrigued by capital markets since childhood. I could see, every day sensex rising, falling, and a lot of my friends started investing in college. But I always thought that I do, till the time I understand, why a certain price of indexes and stocks goes up and down, I will not be comfortable in investing. So that led me to a study of the capital markets, and it took me down to a rabbit hole of reading books and researching, which ended up, I can say that my library is almost holds about 900 to 1000 books right now. I still don't I still can't say that I know for sure why prices go up or down on a particular day. But broadly, now one feels that one has the understanding good enough about the capital markets. My education finished, and then I was lucky to start in a fund management career. This is so through some events, I was supposed to study in the US, but I think my destiny was to work in India. And and I started working as a fund manager, and at a very young age, I think at somewhere around 29, I became a fund manager. And some say it's one of the youngest fund managers in India. So I couldn't have asked for more. And then, felt that I felt like I'm a fish in the water. So I felt this is the perfect job for me. And I never looked back. Also, Prince, my goal in life was to start something of my own, and before 40, in a way, my first goal was to become financially independent before 40, and because of the grace of God, I think I achieved it. And then, I started this. Uh, Fund with one of my very good friends and mentors, Vinod Jain. We started this AIF called Bristlecone, and it's just been about 5 months, here in this journey. So I think that's a bit about me. We'll explore more, and I think you know, uh, let's make it more interactive along with the audience as well. I'm not just a speaker here. I'm also a student of markets, so I also want to learn. So yeah, so let's take it forward.
Great, Vyang. So, Vyang, please check a little bit on the voice thing. The voice was okay, but in between times it was breaking, so we can check that. So, coming to the another important aspect of investing, rather to say the most important aspect, which is the process or framework of investing. So, would love to know, Vihang, what investment thought process or framework you use starting from idea generation to finally investing in a company, and that too, you have been in the markets for over almost 2 decades, 1 or 2 years here and there. But again, how had been the evolution on the framework part, and if we are to categorize, like which category do you consider your framework in? Do you fall in the deep value thing, growth, or maybe an aggressive investor or a conservative one? How you define your framework? Yeah.
So Prince, I think it starts the same way with a lot of investors. It was the same for me. I started with deep value investing. We are all taught, जैसे to go into a shopping mall and अगर कोई शर्ट 1,000 रुपए की है and there is a 70% discount on it and it's available for 300, we suddenly become happy and we want to go there and buy that rather than let's say if a good quality shirt is available for 500. We don't we don't think that way. We are all brought up, India has come through that journey where we all value our money, and that's the same way I also started. I used to run screeners for value stocks from book value to price to earnings, etc. Now, one thing that, and I was very lucky, I should say, in hindsight, I was able to buy a lot of, quite a few companies in the 2012-13 bear market at a very, very cheap valuation. I think one of the companies that I could buy for something like point one times book and one time earnings, price to earnings, and it went up some 20 times after that. So, we all started that way. But slowly but surely, when I came to know that if you just buy cheap stocks, if you just screen for cheap stocks, you're also screening for bad quality businesses because generally it's been now about 70, 80 years since Benjamin Graham has taught us, and everybody now understands that one should buy good quality businesses with longevity. But so hence nobody touches these bad quality businesses, and they also go through a cycle. But ultimately, you have to understand that if you buy something at you know 50% discount to its intrinsic value, it can only double from there. Maybe it pendulum swings the other way, and you get 150% of intrinsic value, so you make a three times your money. But that realization quickly came, and then I also understood that sometimes the business quality is so bad that you end up waiting a lot, or you don't end up making a lot of money. So after that realization, by the way, let me check the audio quality right now. Is it okay now, Prince?
Perfect. I'll come in between as and when if it breaks.
Sure. But after that, Prince, my investing evolved, and then I started understanding that the biggest reason why people buy cheap stocks is the margin of safety. So the thought process is that if you buy a, let's say if you buy a 1,000 rupee shirt for 100 rupees, you can only lose 100 rupees, right? And the probability of it being not even worth that is very low. But in stock markets, it's a growth business. Stock market, you come for growth. The biggest, I realized very soon that the biggest determinant of the margin of safety, is also the quality of business. So, for example, if a 1,000 rupee intrinsic value stock is bought for 1,000 rupees, and then the business grows and it becomes 5,000 rupees in, let's say, 10 years, and you also get some re-rating, then maybe you can have about 7,000 rupees worth of intrinsic value, stock price, in 10 years. But let's say if you buy 1,000 rupee intrinsic value stock at 500 rupees, and that business doesn't grow in the next 10 years, then at max you might hope that somebody else will come and buy it for 1,000 rupees, and that's a doubler. So, so the biggest, one of my favorite authors is Seth Klarman and his Market of Safety. One of the overlooked areas of margin of safety is the quality of business. So, when you're buying a good quality business, you can be sure that the intrinsic value keeps on growing in the next 10 years. But when you're buying a poor quality business, you have to continuously check that the intrinsic value doesn't drop over the next 10 years. So in many cases, ultimately, you are interested in what the business does after 10 years if you're a long-term investor, or 5 years. I'm not interested in what happens after 3 months or 6 months. So that is one change, since you asked about the evolution that has happened. And I have come from that deep value framework. I have seen the perils of it. I have also been lucky to make some money, but I would say that I have been lucky in that. And now I have realized that it is generally the quality of business which determines the returns in the long, and not really uh, just the current valuations. Would also love to know your thought on this, Prince. What do you think about this?
Yeah, Vihang. So you talked about quality of business, and there are bad businesses. The quality of those businesses is not good. So how to make a segregation? How you define a good business? And I mean, also as you told about certain screeners, when it comes to idea generation, so screener is only one option, or do you get ideas from other options as well?
So, screeners is, an option to just filter out where you don't want to go for sure. But usually I think quite good ideas come from discussions, uh, not just with other investors, but with a lot of industry participants. I think one of the tips one of my mentors gave me pretty early in life was that we should have friends from outside the investing industry. So, you should make friends with doctors, sports people, engineers, and a lot of them, have very different perspective to life versus you. And many times, that perspective, helps you in generating ideas. So if you talk to an investor, he will be looking at the world from the investing lens only, which is कि election में क्या होगा, बस कहाँ जा रहा है, sector is going to perform, where do you see value? These are the questions, these are the discussions that you will have if you have friends from investing industry. If you have, let's say, friends from the sporting industry, they are going to speak about, how are the sports companies doing in India? How's the infrastructure development helping sports people? How India is climbing up, in the ranks? How is per capita income related to, Olympic medals and things like that, right? If you speak with doctors, they are going to talk to you about various pharma companies. They are going to talk to you about healthcare industry, and that I think is a much better way to generate ideas than just attending investor forums and talking to investor friends. So I feel that that is, I have started to use. Those are the methods which we have started to use more often than just running screeners nowadays.
That's great, Yang, I must say. And knowing directly from the people, or you can say expert, is indeed they also tell you about what's good, what's bad in the industry, and definitely that is a great help. So Vihang, coming to the quality of business, what all parameters you see basis which you define the quality of a business, be it the management or the financials, etc., etc.
Uh, so should I cover the Lindy effect as well, Prince?
Yes, yes, please, please, yeah.
Yeah, so this is that's the central idea for quality of business for me. So I'll just explain what is the Lindy effect. So for example, the Lindy effect says that the age of a particular idea or a thing is directly proportional to the probability of it surviving that much longer. So, in simple terms, for example, uh, a Bhagavad Gita, as a book, is we dispute when it was written exactly, but let's say about between 2000 to 2500 years ago. It has been that old. That book has been read and it has been published for a long time, which is about 2,500 years. The probability of that book surviving another 2,500 years is very high, you know, just because it has survived for so long. So during this time, there must have been a lot of changes in terms of our reading habits, in terms of the religion that is followed, etc., etc. But this book has survived, and that's the reason it will also survive longer. But versus that, you take the let's say, for example, yesterday's Economic Times. Now that Economic Times is survived for just one day, and it is not going to survive for more than another day. You might refer to some articles, let's say 6 months down the line, but you get the point that something that has survived for 2,500 years will survive for long, while something that is just a new thing in the market will just die as quickly. So that is one model that I used to, that intrigued me, and I applied it in the stock markets. If you see, the best companies that have made you returns are the companies which have survived all cycles. Look at a Nestle, or look at a Bosch, or look at a Maruti. I'm not just talking about large caps. There are many mid and small caps as well, which has survived throughout cycles. And those are the Eicher Motors, many of the PSUs now, which have made money. So these are companies which have survived for a long time, 50, sometimes 20, 30, 50 years. And they have a higher probability of surviving in the next 20, 30 years. And when you are choosing such companies, you are increasing your probability of success. Versus that, very, very fast startups. One of the education startups you've seen, which came so fast, and then has also you've seen a lot of churn in these things. It's not that they don't make money, but the probability of success is small because the longevity of that business is low. So one of the screeners or Lindy effect, the way to use that is you have to study that how far is this uh, you know um, business survived, and then you have to see that how well that business has thrived across cycles. Our paints companies is a prime example. Uh, Throughout, one of the biggest raw materials for paint companies is crude oil derivatives, and crude oil has fluctuated in our lifetime from $30 to $140 and back. And at that same time there has been competition which is coming in, and many MNCs are present in that sector, but yet the top two companies have increased their market share, gained market share, and created a lot of wealth for shareholders. These are companies which have uh, passed the Lindy test, which is that they have survived across cycles. And That is one of the key screeners that I feel one can use to reduce a lot of mistakes. Am I making sense? Any questions on this?
Yeah, indeed, Vihang, you can continue. When you stop, I'll come again with next question.
Sure. So, the idea behind my fund as well. The fund's name is Bristlecone, and a lot of people ask me what is the meaning of Bristlecone. Bristlecone is the oldest surviving tree in the world. In fact, not just tree; it is any species of across the animal world and the trees, flora and fauna, which have survived in the world. And the oldest surviving tree, is about 5,000 years old. Now, 5,000 years old predates the Gita by 3,000 years. It is almost, it must have been planted at the time of Mahabharata, which is supposed to be 5,000 years ago. And that tree, if, has seen, environments across famines, floods, typhoons, all kinds of calamities have happened, and it has still survived. So the idea was that we also want to build a portfolio which is as robust, which can survive any kind of uh, environment, macro environment, whether it's a recession or commodity prices spike up, or pandemics or world wars, etc. The idea was to build a portfolio of companies which can survive and thrive, across time frames. And that's the reason we named the fund Bristlecone. By the way, just a trivia: the oldest tree is in some forest in California, but its location is kept as a top secret because they don't want people to visit there and damage it. You can Google it up; it's quite interesting.
So,
Hello,
Vihang,
yes,
portfolio construction. Am I audible? Hello?
yeah,
Am I audible?
yes, yes. Now you're audible.
Okay. So I was asking, you talked about the portfolio thing. So how does your portfolio looks like, in the sense like how many companies you prefer, what's the kind of allocation you keep, and uh, how frequent or how delayed churning is part of that portfolio? Would love to know from you.
All right. So we have a very simple idea that we'll have about 20 stocks in the portfolio. That's enough diversification. And the strategy is a flexi-cap strategy, wherein we will have representation across mid and small caps and large caps. And the central idea of the portfolio, apart from and using Lindy as a filter, is what we call the U3 strategy, which is undervalued, underowned, and under-researched. Now there is this idea in the markets that anything that is expensive, is good quality, and expensive has to be good quality has to be expensive. Now, one thing is there that good quality is rarely cheap. There are times like March 2020 or April 2009, when or maybe 2013, August of 2013, when good quality also becomes cheap. But apart from that, yes, you pay a premium, but you need not pay a premium for every stock that is good quality. That's also not true. So one of the frameworks that we have started using is our U3 strategy, wherein after we decide that this stock is worth investing, we screen it across three parameters. Is the stock under researched? So we don't want to buy into stocks which everybody understands. The stock should be under researched, which means that there should be few broker coverage, which means that there should not be extremely well researched knowledge about the stock, etc., etc. We have a few parameters. The second thing that we look at is the stock should be under owned, which means that you know now very few institutions or investors should own it. Uh, the reason for that is that usually overowned stocks, mm, are generally stocks which do not create wealth over the long term. That's what our research says. So we want the stock to be under owned as well. And the third thing is a easier thing is to have that stock which is undervalued. So and that we have our own parameters. Now, how the way we evaluate all of this is through our own processes and our own IP. We also use some amount of data analytics and uh, you know, uh, AI is a abused word, but yeah, some part of data science in finding this. And when these all these screeners move on, when these all these stocks are filtered based on all these screeners, that then it's the time to have portfolio allocation, where we decide how much weight to allocate to these companies. Uh, the portfolio is well diversified across sectors as well. So we don't play big themes here. We might be underweight, overweight on sectors, but we will have representation across the large sectors in India. The mapping versus index by definition is very less because most of index stocks will be over researched, over owned, and maybe overvalued. Um, so the overlap with a mutual fund or an index will be very low. Uh, so that's in a brief, Prince, how I construct the portfolio.
So Vyang, on the allocation thing, is it like obviously all would not be same weight in the sense, but broadly like how it goes, some top five, seven ideas covers the most of the allocation, or you equally distribute so as to like it goes for you? And there are occasions when your one of the ideas becomes a very big chunk of your portfolio. In that case, how you go about it?
So we have again eliminated. See, one of the ways to make lesser mistakes is to take lesser decisions. The more amount of decisions you take, the more number of mistakes you will make. And investing, is about making lesser mistakes. It's a field where I say that it's a field where 50% hit ratio is a very good ratio. If you see across great investors, including in the West, Warren Buffett, and in India, the greats like Rakesh Junjunwala or R.K. Damani ji. Uh, they have made most of their money with a few good ideas. So the hit ratio in investing ought to be low, and it's a field where you make lesser mistakes. Think about it, like if you're a pilot, you cannot make any mistake. Your first mistake is usually your last mistake. So a pilot needs 100% strike rate, but an investor can do very well even if he has 50% strike rate. Now, in that framework, if you reduce the number of mistakes, you have a slight edge, wherein you start making, let's say, from 50, you make it 55 or 60% strike rate. So one of the decisions that we have removed is the decision of allocation, where I allocate almost equally 5% in all ideas. And then, whenever the ideas kind of grow up, if let's say something becomes 8%, 9%, let it stay. So unless it starts, uh, there are a few things happen which we will cover in our selling decisions. I don't really tamper with the portfolio. So so that's the way the allocation takes place. We have kept it very simple.
And Vyang, the client onboarding is indeed a very important aspect of public money management. So although yours fund is a very new in the sense you just talked about like 5 months ago you started. But on this front, what are your like do you have some filtration process on that, or how exactly? Because the client behavior is something which is very instrumental as far as the performance of the fund is concerned.
That's an excellent question, Prince. A very mature question. I feel that the asset manager the fund manager is as good as the funds that he has. One of the things that I joke about is fund manager without funds is just a manager. You are only as good as your client, which gives you the funds. One of the things that we've done is, see, we are in this game for the next 30 years. And that's because I feel that's I'm 38 and 70 is a average lifespan in India. So let's say 30 years is what we will manage this fund for. At least, I will manage the fund for. So if we have that kind of an horizon, we are not in a hurry, and we are doing it because we are very passionate about this business, where we see that we can make a difference about in money management. And our vision really is to be the one of the most respected asset management companies in India. It is not to be the one of the largest or one of the most profitable asset management companies in India. So when you have that vision to be the most respected, your investors should also align with that vision. So one of the things that we have done is a very strict criteria for onboarding of clients is the maturity of the client in that system. My partner is one of the top 10 mutual fund distributors of India, and a lot of clients are onboarded, from that platform, and we know the client very well. How has the client performed in different cycles? How is it? How is the maturity of the client? Can the client really? The ticket size in an AIF is 1 crore plus. So, can the client really, afford to go through a period of underperformance? Is the money that he gives us, is it really necessary for his survival? Or is it excess where he has a long-term horizon? When you ask in India, everyone is a long-term investor, right? But, when the first crisis hits, most of the people start panicking. So I can say that the filters that we apply for our stocks, we apply the similar kind of filters for our clients as well, and the distributors as well. So everyone has that long-term vision. Everyone has that long-term horizon. There will still be. I am expecting, from my mutual fund background, I managed a fund which went from 300 crores to about 8,000 crores when I left in AUM. Uh, and I saw that there will always be clients who check out because of various reasons, and there could be reasons, could be personal reasons, could be market related reasons, could be a lot of other things. And you should be okay with it. But the when the problem starts, when the amount of clients in the fund, when such clients have formed a larger percentage of your total clients, that's when problems start, because then you have to change your mandate and change your vision. So we are not in this because we are not in the game of big assets and just gathering money very fast and growing very fast. We feel that can afford to have big filters for our clients. One of the other things, Prince, Lindy effect is whatever grows slowly lasts longer, and whatever grows fast, very fast in the beginning, the probability of that, faltering is also high. If you see an oak tree, it takes many years to rise that tall. But if you see, let's say, for example, a banana tree or a bamboo tree, it grows relatively faster. And the age, nature teaches us that the age that both these trees survive for is very different. So that's another. So one of the so to answer your question, how do we tackle this problem? First is to have a firm vision. Second is to give the client that vision, and third is to have very low expectations from clients. This is one point which I missed. So in the age where markets are talking about, markets are giving 30-40% returns and investors are expecting much more, we are talking about mo- pretty modest returns. For me, even a 10% is a very good return. uh, what happens after that is secondary. But I feel that when a client onboards, my communication is that if you have a post-tax fixed deposit plus returns, I think that's a good expectation to have. So when you have, if most of the clients will not will probably check out with that, right? And whoever remains, they are mostly people who can remain for longer. Uh, so 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 yeah. So those are some of the thoughts.
So, Vyang, coming to the 3U formula, wherein like undervalued, underowned is and under research, right? So, talking about the themes, be it like the solar renewables or the data center, or for that matter, any other theme, EV or whatnot, right? So these are the widely covered, or you can say widely researched sectors or themes, you can say. So while filtration, so you won't be like choosing anything from these things, or it would be like there would be portions within these themes which fall or say satisfy the 3U criteria which you follow in your framework.
So what I'm going to say might not be a very popular opinion, Prince, but but that's what I believe in. I feel that by the time investors start understanding a particular theme, it is already too late. If and we have a lot of studies to say this, because what happens is we have thought that these are the three areas of returns: under researched, under owned, and undervalued. Now, whenever a theme first starts coming in the market, it's the smart money which buy, and you would have hardly heard of that theme. The stocks are cheap. The promoters themselves are buying from the market. There are buybacks which are taking place, etc., etc. For example, let me give you an example here. For example, the IT sector. In 2000, the IT sector topped sometime in 2015, 14, 15. And then for the next 5, 6 years, 4, 5 years, the stocks did not perform at all. Almost zero returns or negative returns in most stocks. Then a lot of IT companies started going for buybacks. Some of them promoters increased their stakes, in some companies, and some smart money started buying these companies because the valuations were very cheap. They were under-owned versus an index weight of about 10%. I think most mutual funds might be holding zero or maybe less than 4 or 5%. And it was supposed to be a bad business because automation was going to take over and it would destroy all the companies in India, and Indian companies were thought to be not doing the great stuff that Western companies were doing. That was 2019, and then suddenly COVID hit. 2020, what happened is, uh, a lot of work started going remote. All of us started working from home. Similarly, in the US, people started working from home, and we started ordering online. We started doing a lot of stuff online then, watching movies and shopping online. And this required a lot of back-end work to be done by Indian IT companies. So the demand suddenly rose for IT companies. Before this came, the stocks went berserk. Some stocks doubled, most of them tripled, some went up 7, 8, 9x in the mid cap IT space. After the stocks which were available at 10, 12 PE, went up to some mid-cap stocks went up to as much as 70, 80 PE. Then we started hearing about the digitization theme, where we saw that everything is just going to be automated. Everything is going to the digital spends is going to go through the roof, etc., etc. I don't know if you remember this, but a lot of us started talking about how Indian IT companies will go through a big growth path. They delivered 20%, 30%. Some companies delivered 40% plus growth for 2, 3 years, and then valuations went berserk. What was under research started becoming over researched. What was under owned by mutual funds and general retail public started becoming over owned. And what was undervalued at 10, 12 PE started becoming overvalued between 30 to 60, 70 PE. But people started owning that stock because they understood the theme then. So once they understood the theme, the returns started disappearing. So you saw that in 2021, 22, 23, now it's 24. Most Indian IT stocks have not made any money. And and I feel that that pattern repeats every time, whether it's 2015, it was pharma, before that it was the Swachh Bharat Abhiyan. Then after that, it was yeah, infrastructure, road infrastructure. So a lot of these themes, when my check is, and possibly we'll speak. This is our first call, and we'll keep hopefully having more of these calls. Let's see how these themes that we are discussing today they pan out in the next 2 3 years. My guess is, I'm not saying all of them, but my guess is most of them, the it's already in the price. And when it's already in the price, if you are buying a good company back then, one of the big themes 2 3 years ago was quality at any price. And we thought that we will do that. You have the secret sauce for success, but that did work. So I'm not saying that nothing will work, but I'm not a big believer in themes. I'm a big believer in longevity of business. I'm a big believer in quality of business, and I'm a big believer in buying a business at a price wherein you have the hope for making money over the next 3 to 5 years.
So, Vihang, recently RBI guidelines came, especially for the infra companies, lending to the infra companies. So there are certain, like, if I'm not wrong, the kind of, I mean, they increase the percentage of amount which has to be blocked or kept uh, for such projects in which the companies fall, right? So how to deal with such kind of regulations when they come from? I mean, obviously they are unannounced, and the very next day all the companies related to that fall big time. So how to deal with such situations?
The question is that whenever the broader question is that whenever some kind of a regulatory action or some kind of an unforeseen event happens, how to deal with those kind of events as a long-term investor. I feel that one of the things that, see, we can never predict yeah, these things, right? Now information advantage is almost of most of information advantages is illegal. So you will only come to know of these things when they are in the media. So with that assumption that you will always be late to the party in understanding what has happened, and then when you know that all the companies have already cracked, uh, the only thing that you can do is have a very good understanding of the quality of business. So, every business, as I said, goes through things which hit it very hard. Nobody predicted the COVID. It's a once in a century event. RBI guidelines is just a thing which keeps on occurring many times. But let's take the example of, let's say, a once in a century pandemic, right? Now, one question that I ask myself, and is that is this particular stock price fall going to weaken the business? is this particular event going to structurally weaken the business? And the weakening is in relative to the other competitors in the business. So, for example, let's take paint companies. Uh, let's say, if the crude oil doubles quickly because for example, some Middle East tension, somebody bombs somebody else, and the crude oil doubles, and you have a margin squeeze in the paint companies. The question to really ask is, you will always, first of all, you will always come to know it about it post facto. So, you all chances are that the stocks are already 20-30% down. Now, the question to ask yourself is, if this kind of a rise in raw material prices, is it going to weaken an Asian Paints or a Berger's business? Is it going to will it impact margins? Yes, definitely over the next couple of years. Will the companies be able to pass on that price hike? Because there is almost like a duopoly in this business. They should be able to. If they are able to, ironically, the weaker companies in the product, the small companies with 2-3% market share, they might not be able to pass on the price hike. Distributor margins might be cut. Their advertising budgets will be cut. So versus a bad like I usually say, a good business usually becomes stronger after a commodity after a calamity, not weaker. So after this commodity price hike normalizes, usually the top companies end up gaining market shares, not losing market shares. So, in that sense, these calamities are great opportunities to pick up good businesses. But for that, your understanding of what's a good business versus what's a bad business is very important. And we particularly rejoice when such things happen because they are really one of those rare opportunities when you get to buy businesses in panic. Now, all the examples that I'm giving is for academic purposes only. There's no recommendation here, but that's the idea.
So, Vyang, when it comes to allocating equally, say 5% to each company, so that goes in, lump sum investment, or you build a position over a period, over few quarters, or how exactly it goes? And secondly, like when it comes to selling a position, so say if you invested today with certain thesis in your mind, and that doesn't play out for certain point in time, so how much time do you give to that investment so as to make a judgment that either the thesis was wrong, or you should allow some time for the thesis to play out?
So, taking your second question first on selling, it's interesting that maybe out of the 1,000 books in my library, let's say if about I have read about 300 books of investing, I think 398 books of them are about buying a good business, and maybe only two books are I am not even sure of that. Touch upon how to sell a good business, or what makes up a selling decision. So so we are definitely biased towards making good buying decisions versus making good selling decisions, and that makes the selling part far tougher than the buying part. Uh, we generally sell a business whenever, like, even I am a learner here, as in other areas, but this is something that becomes difficult even for me, because how do you really differentiate between a business which has structurally gone down, which has deteriorated structurally, versus a business which has gone through a bad patch, going through a bad patch. And usually stock prices are way better indicator of the news than the news is of the stock prices, right? Stock markets are better predictor of news than news is a predictor of the stock market. So when you understand that a business has deteriorated, the damage is already done in your portfolio. So one of the things that we have is we have a very strict monitoring about unusual stock moves. If a particular stock price is reacting in a way in which we can't understand, let's say there is a 20% underperformance. I'm not talking about a price fall, but an underperformance versus markets, which we can't explain. If we know, let's say a quarter is bad, or and the quarter is bad because of X, Y things, because of a plant closure, because of stiffer competition, which we can explain, then we are okay with it. But if we can't explain, then it deserves a tougher look. And the tougher look, then the decision is of two parts. The first part is, uh, is this a temporary problem? The second part is that a permanent problem? If it's a temporary problem, then, and we should be sure that it is a temporary problem, then the stock stays. But if it's a probability that it's a permanent problem, then we bite the bullet at whatever loss. We try to wait maybe for a slight bounce. Not that it makes a big difference, but it makes us feel less bad about the decision, and then we get out of it. Most of the times when I have made a valuation decision, it has been a mistake. So usually, to be candid, it is very difficult to hold on to businesses which are above 70, 80 PE. But in the markets today, you have many such businesses which are that expensive, and it is very tough to hold on to those businesses after they have gone up. And many stocks which have gone up 10 times, 20 times, and after that they are valued at that. So you always worry that can this, even if this valuation comes down from 100 times to 50 times, that's still a 50% fall, and the stock is still very expensive. So, experience has taught me that a stock rarely, uh, derates unless the business is structurally damaged. And the beauty of it is that most businesses which get structurally damaged, are derated first and permanently than the before the people at large know of it. Uh, so you have to have that understanding, and it's not a very easy thing, even for the best in the industry. But the effort goes there to make lesser mistakes. On your first question about the allocation, how do I build up position? Yeah, so initial position, I try to buy about 2.5%, and then as the price moves goes down, I build up, and within a month or so, I take it to about 5%.
And talking about the investing mistakes, Vihang, a few you already enumerated. Apart from that, any big mistakes or learnings from those mistakes, if you want to speak about?
How much time have we got? You,
As
you
much
know,
you want to take, Vihang, not a problem.
so my investing mistakes can last till tomorrow morning. So over a 18-year career, that is the number of mistakes I think I have made. But just to cover a few, I categorize the two mistakes in two parts. First is mistakes of commission, and the second is mistakes of omission. Mistakes of commission are when you buy a stock and it underperforms, or it the price goes down, and you sell it and it's a permanent loss of capital. That's mistake of commission. Think about stocks which have fallen 80-90% over the last few years. uh, Mistakes of omission is the second category, where because everything in the world is relative, There are stocks in the index which perform very well in the market, which perform very well, but you don't end up owning them. So you have omitted those stocks from your portfolio, and hence that's a mistake of omission. Now, because of the caution that we have followed uh, across the various funds that I have managed, mistakes of commission have been lesser. There are still there, but the mistakes of omission are far higher. So a few mistakes of commission, have been in stocks where, and that has been exacerbated by the liquidity problems, because in a mutual fund I was managing about 12, 13,000 crores. 1% of that is about 120 crores. When you're managing that kind of a portfolio, getting out of 120 crores in a mid cap stock or a small cap stock is next to impossible, and you yourself damage the price. So part of it is because of liquidity. Even if you understand, you can't exit very easily. So those stocks, my ex-boss used to call them Abhimanyu stocks. You get in, but you in the Chakravyu, but you cannot get out of it. So so those are mistakes of commission, and usually they happen because I have also learned from experience, because you start believing in themes, because you overpay for a business which deteriorates in quality. But I'm glad to say, because of the various checklists, etc., there have been very few instances when a stock price has dropped by 50% or more, after we buy. The second is a mistake of omission, wherein which have been many, wherein I have missed, and most of that. The key learning there is that if you have a filter for stocks based on valuations, I think your probability of committing mistakes of omission goes up exponentially, which means that if let's say, for example, you decide that you will not buy stocks above 50 PE, and if the market is generally expensive, let's say good quality stocks trade at 100% premium to Sensex, and the Sensex itself is 25 PE. So then most of the good quality stocks will be above 50 PE. And because you are still stuck with absolute valuation numbers, you feel that 50p is expensive, and you make a filter that I will not invest above 50p, or you get very easily, you get discouraged. Okay, this is a 15% growth company, this is a 25% ROE company, how can it trade at 50p? But when you make that, you end up having committing a lot of mistakes of omission. So most of the good growers, good cash flow generators, good return ratio companies, get out of here. And I think that has been a learning. So the learning is that you analyze a business first. You completely blind to valuation while analyzing the business, and then later, look at, let's say you have five options after you have done your due diligence, and you want to buy one stock out of them. Then out of that, those five good quality stocks, choose one of them which is at a relatively cheaper valuation. So if you are able to do that, I think then you reduce the mistakes of omission. So I feel, does that make sense?
Indeed, that does, Vihang. So, Vihang, around the topic of Lindy effect, any names, maybe the case studies of the past which fit in the criteria and had done, although you named one or two, but again, a few more case studies if you want to highlight. And after that, I would appreciate, obviously names are not important, but certain pockets within the market where you think your triple U is justified in today's time, or maybe at present point in time, if you would like to talk about.
Right. So I read about a woman, and you can Google her. I think her name was Grace, and she was a secretary at one pharma manufacturing companies in the 1930s. When on her first day of the job, her boss told her that from your first salary, you buy just 3 shares of this company. She could only afford 3 shares because she was a secretary, and and she bought the 3 shares of that pharma company in the U.S. When she lived a long life, I think very late into her 90s, or maybe she crossed 100. And when she died, she just bought these 3 shares. She forgot about it. She completely, she never invested much. Uh, and those shares basically gave bonuses, splits, etc. When she died, she did not have any family, so she donated all her net worth to her school, and they were surprised that this secretary, who never did, very high-paying jobs, uh, she gave them a estate of $8 million. And this, her alma mater was very surprised at this, and they found out that she held through the stocks throughout her life, and that basically made money for her over a span of some 50, 60 years. So when we talk about long term, we talk about 3 years or 5 years. These are people who are for whom long term is 50, 60 years. The name of that company was Pharmaceuticals. And in the same vein, in my previous role, when pharma sector was really beaten down, and in 2018, when markets themselves were crashing in small caps and mid caps, that was one name which was available, not really cheap, but relative to its history, it was available at a good discount. It was under researched, nobody knew about it. It was under owned because people were not interested, and it was undervalued. We entered somewhere around 4,000 odd, and in quick 2 3 years, the stock went to 20,000. Uh, it's these are examples of good long-term companies, which are great businesses, and which have given you returns like the cheap stocks or the theme stocks that you like to buy. And I feel if you look at them, these are stocks which a lot of us. These are products which a lot of us, if you ask our parents and grandparents, they consume every day. So there is without they are so crucial to our survival. If you ask me, can this be in the next 20, 30 years? Will these companies survive? I would put my money, yes, they will survive. Will these companies have better products? Will we spend more on these products? I would put my money, yes, we will. And now you just have to ask yourself, are these stocks under researched, under owned, and undervalued? And when they are, then the time is to pounce on them. So, similar example was in the bearings industry. 5 years ago, the bearings were a bad name. So one of the common things that I would want to our listeners to understand is, usually money is made in things that are not popular. My personal checklist is whenever I'm buying a stock, if it makes me uncomfortable, if it makes me think 20 times before calling my dealer and putting that order, we have allocated 5% to every stock. If it makes me very uncomfortable to finish all my 5%, then I feel that that's a good decision. That's a qualitative way of understanding that there is a lot of discomfort in history and in price and at present, and that's the reason why the market is not why the market is rewarding you with such good valuations. So once you pass that checklist, Prince, that's when you realize that you made a correct decision. I was talking about the bearings industry. Most of these are very, it's again a oligopolistic business. In most of the categories, you will have one single leader and two, three smaller companies. The pricing is quite good, and the competition is quite low. But capex, etc., was not good themes 3, 4 years ago. And now suddenly post-COVID, the valuations went through the roof. Uh, so that and the again these companies have been around for the last 40, 50 years, all of good businesses. So that's again Lindy effect in play. Currently, while I would not take names of stocks, but I feel that even in these overpriced markets, there are pockets of opportunities which are overlooked. One of the we invested in one of the sleepy giants in the tech space recently, and you know we, uh, we are still building positions. I won't be able to tell you the name, but this is a company which is again a giant in its space, very good, very less little competition, does very different work from the general Indian IT companies, and it has been discounted as a company which never performs. So once when you do this, I feel that it could be a good opportunity. Second opportunity is in the agri space today. I feel uh, a couple of very old, very well respected names uh, are available for a good discount, belonging to good, very well respected groups in India. They are available. They are under researched, under owned, undervalued, and in many of the cases, promoters are also accumulating the stock, even in this pricey markets. So, so these are some of the examples where even in these pricey markets, you have these opportunities. But I definitely feel that the market valuations do make a difference uh, in the ease of finding. It's just that your job becomes tough.
Right, Vyang. So quickly, Vyang, like different sectors, if you have any view, you can share. Otherwise, you can give it a pass. So banking and financials, what's your view at this point in time? Broadly, the sector view.
Uh, I have been a bear on the banking sector for the last 3, 4 years. Again, it's one of the themes which was oversold, I felt. A lot of those stocks, had bloated valuations. Post-COVID, because of easy liquidity, they had good names. So so I felt that if and even currently, despite the low valuations, I would be cautious in picking names. There will be some names, obviously, which are doing good businesses and at different valuation, but broad and large, I would be okay giving it a pass, like I have done in the last 2, 3 years. In fact, I used to run one of the funds which had zero banking 3, 4 years ago. uh, the private banking sector has underperformed the Nifty over the last 3, 4 years in a big way. Some of the stocks, some of the large, well-known stocks in this space are still at pre-COVID levels, while the indices have almost doubled. So I feel that that will continue. It is one of the classic examples of a over-researched, over-owned, and overvalued, and I would still say overvalued sector, because the banking sector per se is a sector of very high leverage, and with that leverage, comes risk. So a banker just needs to do a 10% mistake in his business, in his lending, to go bankrupt. But in India, the banking business is thought was getting valued like an FMCG business earlier. Now, investors are and you can see that still there is no disaster in the sector, but still the derating has happened so much. So these are all personal views, as in, I'm obviously there will be a lot of different, there will be as many opinions as there are people in the room, uh, but I would still be cautious.
Right. And on the FMCG space, Vyang, and any thoughts like the rural demand that has been picking up? So how that would impact the consumer space and the FMCG? Yeah.
So the FMCG is one sector, except for the tobacco measure. Most of the stocks have underperformed over the last 2, 3 years, and I feel that's because of the general slowdown in the rural economy. The volume numbers have not been great over the last few quarters. I think this rural revival, has also come at a time when elections are on the way, and I feel that the rural economy also has its own cycles, apart from the seasonal rainfall cycles. I feel that sector holds more promise. There are obviously amazing businesses, one of the best businesses with the best probability of survival lie in this sector. Now the valuations are also low. If you see that, I don't think that anybody is talking about FMCG now, and I feel that that makes it a good bet right now. It also gives you a cushion if at all you have some, market uh, corrections. This is one sector which protects the portfolio in a very good way. So I would be, I would be selectively positive on that sector.
Right. And in the chemical sector, Vyang, although agrochem you touched upon, the results have been not so promising. So we can see a certain, I mean, the results have been subdued, you can call. How you see the sector as a whole, although it's a very heterogeneous space, and but again, any thoughts around that?
Yeah, you like you rightly said, it's a very heterogeneous space, very different companies. But again, I go back to my observation on themes. If you remember, Prince, 2, 3 years ago, chemicals was a theme for India plus one, sorry, China plus one, and make in India and all of that. And the stocks went berserk with valuations, where chemical companies, I have seen chemical companies in 12, 13 at 5 P, and because these were commodity companies and they started trading at 50, 70 PE in some cases. I have seen one of the IPOs even came at 100 PE. And that was a theme which didn't play out as well. Now you're seeing the that it was just a positive cycle, and most companies are slaves to the cycle. So now valuations are coming back. I still would feel that there is froth. There are The good part about the sector is it is one of the sectors which has decent ROCs and where you can invest a good amount of capital. You see, that's not the advantage that FMCG enjoys. FMCG has excellent ROCEs, but there is no necessity for HUL to invest because it's a negative working capital business, and there's hardly any fixed capital required. But this is a sector which, so that makes me hopeful. But I would still wait for valuations to come down, and there might be a cyclical upturn because it has been 2, 3 years since the cycle has been down. I would selectively again be hopeful, but I'm equally cautious there. You can see that I'm not made up my mind on that sector yet, but there are, because it's such a heterogeneous space. For example, some benzene derivative stocks might be good, but some oleochemicals might still not be good, and things like that. So difficult to paint everything with the same brush there.
And same goes with the pharma and healthcare space, or you have a differentiating views. Although the sector as a whole is showing strength, be it due to the drug shortage in the US for companies which has exposure to the US and the Europe, and even the domestic focused companies have done great. So any thoughts around the space, Via?
Yeah, so I had been, a pharma bull for the last, again, my weight from banking was actually invested in pharma. And you can see that the US cycle pricing cycle has gone through a trough. I feel that we can still, while the stocks have performed, there still can be room for further performance. uh, Indian stocks as well, I think it's one of the best proxies to FMCG. One of the things that you can notice is you might experiment with your toothpaste, you might experiment with your uh, shower gel or soap. You can experiment with your shampoo, but you will never experiment with your blood pressure medicine. And you will spend the same amount of money in both. So in a way, the brand loyalty in pharma is much higher than that in FMCG, which makes them a far better businesses in some sense. And I feel that's the reason I am a long-term bull on pharma. Uh, Stock specific, there might be excesses, but at the other end, there are still very good companies which are doing some extraordinary work even in India. Not just their uh, generic work that we have come to expect. They are doing some good R&D, etc. But it's just that they have not shown good results, and that's the reason the stocks are cheap. So there are very good opportunities, I think, still there in pharma.
Right. And we as an economy are going towards the manufacturing hub, although that is a distance reality, but the companies have been doing good, and we also see much of potential going forward. So do you see we have some comfort in that space, and that again is like a very big space, not limited to any particular company. But do you think like we can also play the sector, and are your thoughts about that?
See, when again, when we what happens is in the markets, you a particular subsector or a particular theme takes a big portion of the market collective consciousness. Okay, so a lot of people will be starting to equate, let's say, manufacturing with, domestic manufacturing with, let's say, the electronics assemblers, right? And those companies go through big changes, in valuations. They become overpriced. But at the same time, we forget that there are many auto ancillary companies which are also doing good work, which are also exporting, which are also manufacturing in India. Many of them are global giants. Some of them are only listed in India, and they are also doing great work. But because they don't get the same bandwidth, their stocks can still be cheap. At the same time, even pharma is a make in India story. There are a lot of Indian companies which have done great in pharmaceuticals and chemicals. Their Make in India is a theme which is here to stay. I feel that the with China having done in the last 30 years, what it has done, and the labor costs they're rising, and plus because of the one child policy, the population there, coming down over the next few decades. India is the obvious source. We check all the boxes. Can we Are we a definite beneficiary? Yes. Are there still spaces, uh, lacunae in execution? Also, yes. But definitely, there will be a shift towards low-cost countries like India and Vietnam, etc. But what I'm saying is that the names which are touted and the subsectors which are touted need not be the only ones which, perform. There might be others also which are hidden in plain sights and which can perform as well or better.
Yeah. So Vyang, there are many cyclical sectors, and any. I mean, do you cover also in the sense like you also invest in deep cyclicals kind of companies, or that doesn't fulfill the criteria you are in? And especially if you do, then any thoughts around the metal companies, the cement space, the sugar space, if by any chance you have any thoughts?
No, so definitely, I don't belong to the camp which says that, cyclicals are a complete no-no. Internally, I have kept about 10 to 20% of the portfolios in across cyclicals and turnarounds. Uh, one of the best books I think in the written in the recent times is this Pulak Prasad's, What I Learned from Darwin. And there he says that turnarounds and cyclicals by definition have a very low probability of success, and I completely agree with that. It is just that I feel that I have worked. I have been able to unearth some ideas in my past which have given me really outsized returns. And I don't want my investors to let go of that opportunity, which is why I invest in them. At the same time, I don't have any illusions that the strike rate there is quite low, and hence I don't want to overexpose my investors to such a volatility. And hence, I keep that exposure limited to about 15% of my fund. So, which means basically three, maybe four stocks at max. On the metals space, again, it's in any cyclical, you just buy mean reversion, and you buy it at the timing is also very important. So, most other companies should be bought cheap and sold expensive. But in cyclicals, you have to buy them expensive and sell them cheap. Predominantly because when the earnings are very high, when the margins are very high, what the future is definitely the margins and the earnings are going to come down. And, that's why when they're expensive, you got to be cautious. So, what I like in these companies is also a few of them. In metals, we have one of the large ones, which is a global leader in cost leadership in steel. In cement, we have again a global leader, which is a cost leader in cost of production. So that's one structural advantage, right? Any other way, you cannot have while cement in India is branded, but that brands don't really make a big difference, but the cost leadership does. So if the DNA of the company is to continuously innovate and reduce its cost, I think that's a big advantage which helps a company in the long term. So I feel that that is one thing that I keep looking at. But one thing I also have understood over the last couple of decades is that whenever the cycle turns, usually the least efficient and the most overdated, in fact, the worst companies do the best. So paradoxically, while we are bent towards quality, when it comes to cyclicals, one has to look at companies which will survive the downturn, which are not so indebted that they will go bankrupt. But one has to look at companies which will, which will come back with a vengeance. So when that happens, usually the best quality company in a cyclical sector doesn't perform as well in an upcycle as the worst company in the sector, if the worst company survives. So that's one nuance that one has to look at while investing in cyclical. By and large, I would say, it's a very tough space, even for the most experienced people in the capital markets. If you actually ignore all this advice, it is much better for your financial well-being. But if you have to, then these are some of the things that I have learned over the last 20 years.
So, Vyang, EPC space is one which is talk of the town across the board, and even the CNC companies are going crazy. So, any thoughts around the longevity around these kind of businesses? Do you see that? I mean, obviously. At this point in time, valuation comfort is not available. But going forward, do you think they have the required longevity in the sense of the businesses they do?
So not one of my strong points, Prince, but what I feel here is that most of the EPC companies have one client, which is the government, if it's a road company. If it's or usually it's a large corporate, there's a competition there is tough. So a lot of players are competing with one another. Margins are low, working capital needs are very high, and commodity fluctuations are always a pain. One thing I feel that one should do is not just look at profit growth. One should look at the cash conversion. How much is the company? There are very few companies there which are able to, be very selective in their projects. Ironically, in this space, the fastest growing company is actually the surest way to for disaster because usually there are not many, big margin projects to grow that fast. And hence the risk reward has not been very favorable for people who have been able to still mine and find good stocks. I think that's great. That's one sector that I would want to stay away from. Uh, you know, yeah.
And what about the real estate companies and the infra space, which has done well after, you can say, and that space has gone through consolidation, and the players which are existing are comparatively doing good. So, do you think the run up has already been through, or the space as a whole can do better going forward also, be it on the demand supply side?
See, real estate developer side, there is a difference between them and the infra players. In real estate, in the developers, these are, these companies have some brand. For example, I'm from Mumbai. If you look at a Oberoi project here, or if you look at a, uh, Godrej project here, they get some premium, and they also are able to sell faster. So the brand here does play to some extent. Are they like really brands of FMCG caliber or pharma caliber? Answer is no. But are they complete commodities like the infra players? The answer is no again. So somewhere they are in between. Uh, now in this cycle, in the last cycle, companies went through a land grab for the listeners who have been, who have seen the 2005 to 7-8 cycle. That was when they had bloated balance sheets and they had a land acquisition spree. This cycle, a lot of them just want to be manufacturers. In that they either go with they either buy land and they quickly develop and sell, or they want to go with joint development agreements with the landowners. So they want to be asset light, and that's a good development. So in some ways, good brands will do well here. Also, once bitten, twice shy. A lot of us have gone through that experience of, trusting unorganized developers and burning our hands. The real estate purchase is usually one of the biggest buy decisions of your life. It's very ironic in India that to buy a shoe, you look at a brand loyalty. You will look at familiar brands. To buy a shirt, you will look at familiar brand. But one of the largest decision, which is real estate, one goes for the cheapest price, and one doesn't go for good brands. Uh, because we want bigger area, we want lesser as per square feet weight, etc., etc. So, but that all that is changing because of the last cycle, and now people are clearly preferring guys with good brands. So that is one space which is unfortunately the names there are very few. And the other big advantage for many of these players, Prince, is that many of them are also able to borrow at a very low cost. So versus an unorganized guy who might be having to borrow at 15, 18, 20% rates, a large listed organized player will be able to buy at half that uh, cost. And because it's a capital cost heavy sector, that's a big advantage. So I feel that, I think that one can be selective there as well. So, yeah.
Yeah. So we have quick view on the SME space, and then we how what is wealth for you, and then we take the closing remarks from your side.
So not much exposure to the SME space. I feel that by definition, I mean it's a tough space for people who are able to navigate it and who are able to find good businesses. They will be able to do well. I have personally not invested, so would like to pass that. Uh, your last question was, sorry.
What is wealth for you?
So that's yeah. So like I said in the beginning, like financial independence was a big thing for me, and I feel that that the definition for wealth, everybody has a number, but what I have is a feeling. I feel that just ownership of your time is wealth. Of the way I was in my career, the way I was looking at wealth is for me, money was nothing but a stored time. So, for example, if your monthly expenses are 1 lakh rupees and you have 12 lakh rupees in bank, it is like you have stored 1 years of your time in the bank. So, if you have 10 times that money, it is 10 years of your time stored in your bank. So the way I feel about money is that wealth is beyond a number. It is just your ability to spend the time the way you want. For someone who is indebted and who has to work for a living, he has to devote that 10 hours, 11 hours of commute, including commute to his office and his employer. And if we think that our quest towards financial independence is just so that we can have enough wealth so that we can afford to do what we want to do, that's a very different way of looking at wealth than your traditional metrics of I want so many crores and I want so many houses. So my definition of wealth, where you can, where you see that uh, your ability to have the freedom to do what you want is my definition of wealth, and that number can vary according to various people and their own circumstances.
Great, Biang. So quickly, any few good books to your mind which can be helpful for all the investors?
So one of the book I'm gifting a lot these days is the What I Learned from Darwin. That's a book by Pulak Prasad. He's done an excellent job managing Nalanda. Many of the few of the principles that I spoke about have been borrowed from that book. And apart from that, another non-investing book, if one has to look at, is a book called Grit by Angela Duckworth. The central idea of this book is, if all of us want to be successful, all of us want to be wealthy, all of us want to be happy in life, and we try to do a lot of things for this. We get educated, we do a good job, and we try to be the smartest, be the best. But what research showed her is that one of the biggest predictors of success in life is not intelligence, is not IQ, is not EQ. It is plain grit. How much resilience you show towards your goal. If you never quit, if you keep at it, that is what is a best predictor of success. And in a way, the discussion that we started off with on Lindy effect and my fund Bristlecone is the same, that companies which have been resilient, which have had the grit to persist throughout cycles, have a huge chance of becoming successful and winners over the long term than others. So those are the two books.
Great. So, Yang, thank you so much for taking out time for today's session. It was really insightful on your part, sharing your thoughts, and I hope our audience sincerely like that. And for our audience who joined late, they can listen to the conversation, which I'll be uploading in a day or two. So, thank you so much. And guys, we can also connect to Vihang over his handle, although he's pretty new to Twitter, but I have requested him to be more active as he's like more active on LinkedIn. But again, we can request him to be more active on Twitter, sharing his thoughts around investing. Thank you so much, Vyang.
Hey, thank you, Prince. I think I have to credit you for bringing me onto Twitter. I have not been a big social media guy. I have a little bit of presence on LinkedIn, but as I said, I opened this handle. You prodded me, and let's see how this journey goes. And it was really enjoyable to speak with you today. Very mature questions, and you're doing some excellent work on your my channel here. So all the best to you and all the best to our
Thank you. Thank you
listeners.
so much. Thank you, Vyang. Good night, everyone. Take care. Good night.
Bye.